Ladies and gentlemen, welcome back to another episode of Rants and Gems Live. Matt Garland and MLS number 58700, but better known as MG the Mortgage Guy. We are live. We are blessed. Thank God for another day. If it's your first time here, type first time in the chat. Hit the bell for notifications because you never know when I'm going live. So today was a big day, ladies and gentlemen. Okay. A big day in the world of money, mortgages, and real estate. The Feds just cut rates again, another 25%. And a lot of people out there are really just talking about the mainstream stuff, right? The headlines, the big headline. Fed cuts rates again. But that's only half the story. Today, we're going to talk about it, right? I'm going to break down to you what really happened with mortgage rates today, what this means for everybody who's looking to buy real estate in 2026, and why certain cities are about to explode, and how, a couple weeks ago they came out, they raised the loan limits, right? We're going to go through that as well. It's going to give you more buying power and everything. So, watch this to the end, man. It's going to be a lot of information in this. I hope some of y'all got your pen and pads because this is going to impact a lot of you who can hear my voice right now. So let's get into it. The Feds cut the rates another quarter point. Like I said, what does that actually mean? Okay, so first things first, ladies and gentlemen, when the Feds cut federal funds rate, that does not mean mortgage rates automatically drop, right? So they cut us a quarter percent today. That's going to put us around 3.5 to 3.75% range. When people hear that, they automatically think, oh, great, mortgage rates, they're lower. Yo, MG, can I get a lower rate than you quoted me a day ago? No, it doesn't necessarily work that way. If you follow me, if you've been on this channel long enough, listen to me over the last 7 years. I tell you guys, when the Fed's lower rate, and it impacts short-term lending directly, auto loans, HELOCs, personal loans, credit cards, savings accounts, things of that nature. So when they drop rates, those things tend to get a little bit cheaper. But that's not how it works with mortgage rates. Mortgage rates do not move off of the federal funds rates. Mortgage rates can be influenced by it. Influence, keyword, influence, but they do not move off of them. They move off of bond yields, inflation expectations, and the MBS market. Type MBS in chat, mortgage-backed securities. So here's what did matter today when the Feds made this announcement. It was the Fed's tone. The tone has shifted, y'all. Their economic projections show slowing growth. Unemployment is expected to rise. Inflation is drifting down little by little. That combination gives the bond market permission to start dropping yields. And that's exactly what we saw today. And this is why mortgage rates right after the announcement, y'all, they didn't really move at all because a cut was already fully priced. But when Powell started talking, that's when the movement happened. So when the Feds announced the rate cut, mortgage rates didn't do anything. But that press conference, the 3-hour press conference, boy, there was a lot of information that was dropped in there. So here's what happened. The 10-year Treasury yields tick down. MBS, mortgage-backed securities, for those who don't know, pricing improved. Mortgage rates slid into the low sixes. So right now on the 30-year fixed national average, we're probably looking right around, single family primary residence, 20% down, 760 credit scores and above, and the loan amount 300,000 as an example. You're probably looking at 6.125 on a 30-year fix, give or take. With buy downs, you can probably definitely get into the fives on the 30-year fix with rate buy downs. Okay. When people hear that today, the buyers are hitting me up. But I'm going to get into all of that a little bit later, right? But this is the calm before the real drop that's about to happen. Okay. If we get one more good inflation report, if we get one more good inflation report, we're going to definitely start seeing rates in the high fives. But I'm going to tell you what's going to really, really, really start helping us, right? There's a lot that's coming in 2026. I don't know about y'all, but I am so excited for 2026. It's about to be one of those years, yo. Okay? It's about to be one of the years. Look at unemployment, right? This is what you guys got to pay attention to. If you want to see where the market is going, especially mortgage rates, look at unemployment. 2025, 4.5%. 2026, they're projecting 4.4%. 2027, 4.2%. The Fed's telling us the labor market is weakening. Wage pressure is easing and inflation will continue to keep cooling. But then you got to look at their projections of what they're saying the Fed funds rates will be as well. It's a slow, steady grind down. We at 3.7 today. They're saying we're going to go by the end of next year, we're going to probably be around 3.1%. Again, slow and steady grind. But if you don't know, our current Fed chair, he's out in a couple months. And if Trump has his way, which he will, it's going to be a new Fed chair. And I'm sure they're going to be very aggressive. So these projections and predictions that they have today, come mid-year, that thing might change once there's a new sheriff in town. So pay attention to this, right? But again, unemployment is always important, y'all. When unemployment is rising and inflation is cooling, they cut rates, right? When the Feds cut rates, bond yield drops. When bond yield drops, mortgage rates follow. 2026, man, with all the information they spoke about today, is shaping up to be a low interest rate environment. It is shaping up to be a low interest rate environment. And the most important thing that they spoke about, the bombshell that they dropped today, y'all, the bombshell that has me so fucking excited right now. And everybody who's in the industry should be super excited behind this. Is the Fed restarting asset purchases. Oh my goodness. Oh my goodness. The Fed announced that they are restarting reserve management purchases, RMPs. They're about to start buying this month. What's the day? On Friday, the 12th, December 12th, ladies. Type in chat December 12th. Type in chat December 12th. I need to make sure you guys are here and you're following what I'm saying right now. Type in chat December 12th. They're about to start buying 40 billion with a B in Treasury bills. Let me make this real simple for some of y'all who might not know what the hell I'm talking about. Some of you who might be saying, MG, what the hell does this have to do with anything? This is what you call quantitative. I can't pronounce the fucking word. It's a tongue twister. Quantitative easing, or QE. Okay. QE. QE, ladies and gentlemen, for those of you who have no clue what that means, QE is when I told you guys in April of 2020, right after America was closed, I went on the Breakfast Club, pull it up. I said the Feds are going to start quantitative easing and they're going to start buying all the treasuries and mortgage rates are going to drop. And when America reopens, it's going to go crazy. I said those exact words. And that's exactly what happened. Since 2022, the end of 2022, they started tightening. So for the past 3 years, they haven't been buying at a high level. They've been tightening, hence rates going up. They're trying to cool inflation. But now with them announcing that as of this Friday, they're going to start buying $40 billion a month in Treasury bills. This is QE-Lite, y'all. This is going to give more liquidity, more demand for bonds, lower yields. And AKA, all that means is lower mortgage rates. We could be seeing interest rates, mortgage rates, y'all. By this time next year, by holiday season next year, we can probably be high fours. Low fives for a 30-year mortgage. Investment property loans, high fives. Can't tell me. Look, all the big players are already talking about this, right? Morningstar, Reuters, they already confirmed. I've read the documentation myself. They're buying 40 billion securities this month and every month. This is why rates dipped a little bit today, is because of that news when they were speaking about this. And when I heard this, I said, holy smokes, it's about to begin again. So if you're a licensed realtor, loan officer, the moment you have all been waiting for is upon us. 2026, ladies and gentlemen, will be one of those ones. Okay. So 2026 is going to be a low rate environment. But with a low rate environment, you know what that also means? A low rate environment means higher competition in the market. Hold on. Let me see something here. I got to take a little pause real quick. Higher competition in the market. All right. Everybody on YouTube, make sure you like the video. We ain't got enough likes on it. Before I go on, I need more likes on the video. Okay. Before I go on, we got damn 100 people over there. Right. We got 100 people here on Instagram. I need more likes on the video. Okay. Because I'm giving y'all, and I've been telling y'all this shit. I've been telling y'all this for 3 years. When the time comes, it's going to go crazy. It's going to go crazy. People, some of you think you have time. Y'all been watching the same videos about market crashes and the world falling apart for 3 years, thinking it's going to come. No, it's not. You don't have time. Your time is running out. Because here's the chain reaction to all of this, right? Rates drop, buyer demand jumps, inventory stays tight, prices get pushed up again, bidding wars come back. So if you're trying to buy in 2026, you better not wait for the headline that comes out and says interest rates on the 30-year conventional is now 5%. If you wait for that headline, look yourself in the mirror and say, congratulations, I played myself. I should have. You're gonna be one of those memes that I see on Instagram and TikTok of people who walk out the door and said, I should have brought in 2022. I should have brought in 2023. I should have been 2024. You're gonna be one of those people. It's over. Look yourself in the mirror and say, congratulations. I played myself. Because I didn't put myself in position to win because I was worried about the interest rate. I was worried about interest rates. I was waiting for them to drop They told me that home prices couldn't sustain and they were going to go lower. Well, yes, they have corrected themselves, but appreciation, ladies and gentlemen, is appreciation. I've been saying this shit for years. Appreciation is appreciation. 3% appreciation is compounded over years of appreciating. But if we look at the last 4 or 5 years, where you have some states and cities 20, 25%, but now if they're doing 3%, they still have that 20 something percent. For years, it was a run. It was a run. And it's going to continue to run. The competition is going to be out in droves. The competition is going to be out. Your competitors are looking for homes. Look, you want to work with me and my team? I'm going to put in the description of the video how you can work with us. Let's get you pre-approved. Let's get you to the closing table. You want to learn? You stay in your learning phase? Go to mgbootcamp.com. Join the boot camp, Rehab Mastery. Oh, and if you guys learn how to buy right, it's nothing but beautiful things is going to happen for you. But let me continue with my TED talk here, right? Because everything I'm saying, the government just keeps putting out more and more information that just furthers my thought process and knowing that I'm not fucking an idiot here, that I know what the hell I'm talking about. When they came out like a week ago, 2 weeks ago, and announced the loan limits rising in 2026, giving more buy power to people, right? So the baseline conforming loan limit for 2026 is now $832,750. And cities like New York, DC, LA, the conforming high cost loan limit is $1.249 million for a single family. For conventional loans, this is not for FHA loans. This is for conventional loans. For a 4-unit property, you can go up to $1.6 million now. Conventional, Fannie Mae, Freddie Mac just came out, and I reported this a month ago. Yo, we taking away credit scores. The people know what's happening. The floodgates about to open. They're trying to make this as easy as possible for people to buy. Even with home prices rising, they know they're going to rise. So you know what they're going to do? They raise the loan limit so you can put less money down. They're allowing you to do rehabs on your homes, give you 100. Like, look, you got to look how crazy this is, right? The government will literally, Fannie Mae, Freddie Mac, FHA will literally give you 100% of your repair costs to rehab the property and tell you can put down as little as 3%. They tell you, hey, if you buy a multifamily, 2 to 4 units, you can use rental income to help you qualify. Hey, if you buy the single family with the detached or attached garage and you want to convert that to an ADU, you can, and here's the money to do it. All at a low interest rate and a low down payment. And with you buyers still being in position to negotiate, you today can go ahead and say, hey, seller, I need 4%, 3%, and I can use that to bring my rate down from 6.125, 6.25 to maybe 5.5%. Or 4.99 if it's FHA. Like, it's so much opportunity out here for those who are looking to buy, who understand the game and play it the right way. It's absolutely mind-boggling, the options. And the government, with raising the loan limits, is telling you they are preparing for volume. Refinance volume is going to increase. Cash out refinances are going to increase. Why? Because people have a lot of equity in their homes. Once these rates, once this QE-Lite starts and those bonds and those MBSs start getting impacted by this, and those mortgage rates start dipping and dipping, and you guys will see the headlines. I will be one talking about it too every fucking day. You're going to see what's going to happen. And just remember MG told you. Right? Just remember MG told you. You had Redfin today post something about housing markets. Housing markets most likely to heat up in 2026. I saw this on my Instagram earlier. They said these are the top 8 markets that's expected to heat up in 2026. They ranked Long Island, New York, number 1, Hudson Valley, New York, number 2, Northern New Jersey, number 3, Fairfield County in Connecticut, number 4, Syracuse, New York, number 5, Cleveland, Ohio, number 6, St. Louis, Missouri, number 7, and Minneapolis, Minnesota, number 8. These are the markets that they're predicting is going to go crazy. Look, I live in Long Island. Let me tell you, Long Island is absolutely. Let me take the glasses off a little bit. Long Island is absolutely ridiculous, and I love it as a homeowner. As a buyer, I hate it. I hate it for you guys, but for me as a homeowner, I absolutely love it. I absolutely love it. Right? So ultimately, if you are in these markets, if you are a homeowner, be prepared. And if you are a buyer in these markets, if you're a homeowner in these markets and you don't need to sell, prepare for your equity to go up. You might want to think about tapping some of that to go buy you some investments. Inventory is tight in all these markets. Everybody trying to go here. People fleeing overpriced cities. High income earners from New York City come to the island, get more bang for the buck. They go other places to buy. Like, people all across America are tired of some of these expensive cities. So that's why you look at the bottom of these areas. If you look at, Fairfield County, Syracuse, Cleveland, St. Louis, especially Minneapolis, like, these places are relatively affordable. You know what I'm saying? People with money, they're gonna go there. Now, here, let me put this back on. Let me put the glasses back on. Now, with the cooling down markets, these are the top 6 markets that Redfin is saying is cooling down. Nashville, Tennessee, San Antonio, Austin, Fort Lauderdale, West Palm Beach, and Miami, Florida. Those are the 6 markets in 2026 that, according to Redfin, are going to slow down, and they're cooling down a lot, right? Too much new construction, overheated pandemic pricing, insurance costs is crushing Florida across the board. Population inflow slowing. It's a lot of different various reasons. But the boom towns of 2020 to 2023 are definitely cooling, and the Northeast and the Midwest is rising. And I don't know why people coming to the Northeast. It's expensive as hell to live here, but people are coming. People want to be in the greatest city in the world, right? So if you're watching this right now, first of all, if you got some good information from tonight's live, type a gym in the chat or something like that. Make sure you like the video. Always feel free to express yourself, especially if you are in any of those cities that I just mentioned. Okay. I like to engage with you guys in the comments. So please engage away. So if you're looking to buy in 2026, type 2026 in chat. If you are looking to buy in 2026, there's a couple things that you need to do right now. Number one, first and foremost, you need to get pre-approved. Okay. First and foremost, you need to go and get pre-approved. In the link of the description, I'm going to put a link. If you're ready to get pre-approved, just complete the form and we will reach out to you guys. Okay. And the link in the description, or you can go to Garland Mortgage Group on Instagram, click the link in their bio as well. Okay. So get pre-approved 2026. I'm going to help directly. I want to help 300 of you guys who watch me, learn from me, whether you're in the inner circle or not. I want to help 300 people close on real estate transactions in 2026. So hit me up. I'm talking to my people. I want to work with you guys directly. So make sure you go to the links in the description. Okay. Lock in those pre-approvals, get into the market. It's going to be a cold, cold winter. Take advantage of this cold, cold winter. Be outside. Look at properties, put in offers, ask for concessions, do whatever it takes. Be disrespectful if you have to as well. Like you guys know, I'm a fan of that. You know, target the markets with upside appreciation, especially certain cities. Look for distressed properties. People, look for properties that's been in the market for 3 to 4 months or more. Look for properties that need rehab. Stop with this turnkey shit. Whether you're buying a single family, a multi-family, I don't care what you're buying. Put some, for the love of God, put sweat equity into these properties. Buy in the neighborhood you want. Buy the piece of crap house in that neighborhood. Renovate it. The bank is going to give you 100% of the rehab cost. Do you not hear me? Stop being scared. Scared money don't make money. Shout out to Miss Bess on Instagram. She said he legit helped me buy my house in 2020. Best decision ever. Georgia. Shout out to you, Mrs. Bess. Buy distress. Buy rehab. Force appreciation. And when you close on your properties, I'm gonna start in 2026. I'm gonna start making sure that you guys have life insurance, mortgage planning, have you some mortgage insurance, right? Get you a life insurance term plan. God forbid something happens to you, your mortgage could be paid off with the life insurance. Okay, so we're gonna start enforcing that to the people who are in my world, right? So for the folks of you or my world, I want to make sure we setting up estate planning properly. We getting the right insurance. Like we trying to sustain wealth here. It's 2026. Remember they said by 2030. We got 4 years. Okay. We got 4 years. Let's get pre-approved. Let's do this the right way. Let's make things happen. And this is only for those of you who are looking to buy in 2026. Remember, when you're looking to get pre-approved, the pre-approval is good for 3 to 4 months. So don't be running your credit and everything like that unless you're ready. But the main thing is, guys, I want you guys to make smart decisions. Use the information that came out today. I'm telling you, today was so freaking huge. It was so huge with the information. I cannot tell you how excited I am for 2026, especially being in this business. When I hear QE, quantitative easing, and they're trying to rebrand it, you know what I'm saying? It's quantitative easing. They trying to rebrand the joint. No, it's QE. It's QE-Lite. Like, it's amazing. RMPs, reserve management purchases. This is QE-Lite, baby. And if they increase that to 80 billion, watch how these rates drop. I'm telling you. So if you are, now I'm gonna talk to my sales professionals here. If you in the business right now, if you don't understand how to get your clients funded in 2026, if you're not attacking the three major sectors, first-time home buyers, business owners, investors, the trifecta, the triangle offense, if you don't know how to work within those groups and be able to present information, be the advisor to them, because guys, realtors, I'm sorry. Let me tell you this. The days of just sending people listings from Zillow are over. With AI and everything, folks are doing their due diligence, they're doing their research. So you better know some products and some programs. They watching me. If you realtors out there, real talk, new realtors, seasoned realtors, I don't care how long you've been in the business. If you're not focusing on financing and getting deals funded and learning how to get that shit done, how to make the process as smooth as possible. I'm not saying go out here and be a loan officer. I'm saying understand the game, because these buyers are super educated now. They got AI, they got Gemini. Hell, I got my Meta glasses on right now. I could talk to it right now and tell it to do something for me, right? As I'm talking, it bring up something on my phone. This is the world that we live in. You understand what I'm saying, y'all? So you have to be putting yourself a heavy emphasis on your education. If not, it's over for you. You might as well pack your shit up, because it's over for you. Pack it up. It's over. You're not going to make no money. Period. Look, Fat Boy need a 10-piece on Instagram said, facts. Damn near found my own first crib because my realtor was zero help. She just tried to collect at closing. Shout out to Miss McNeil. She says, too many realtors don't want to put in the work. Shout out to you, Queen. I agree. Shout out to all my new realtors, real estate. I can't even pronounce your name. I'm not even going to try to butcher you up, sis, but congratulations on being a new realtor in Texas. You're still figuring things out, but I hear that this is good news for anyone in real estate. That is a fact. Tanish, I don't want to butcher your name. I'm going to just call you T. Okay? Real estate with T. All right? You're 100% right. And what day is that? Hold on. On the 18th, mark your calendars, 12 to 2 p.m. Eastern Standard Time, December 18th, Realtor Lunch and Learn virtually. Link will be available. Yes, T. There we go. Shout out to T. All right, December 18th, 12 to 2. We're getting back to the Lunch and Learns virtually, in person. I'm having Lunch and Learns in New York starting in January. We at the Garland Mortgage Group is dedicated to training our realtors, training our loan officers to be able to help the buyers out here understand this information, put it all together, and help them win deals. Too many realtors are not realtoring nowadays. We need y'all to be on your shit. We as buyers are tired of getting on your Zillow mailing list and getting the same listings that everybody is sending us. No, we need action. Okay. We need off markets. We need deals. Stop showing us the shiny houses. Show us the beautiful house, then show us the beat up house in that same neighborhood. We giving them all the rehab money in your loan at a low rate. Let's grow. It's here for you. I'm so fucking excited about this. MG, how are you handling agents who expect the lender to add to their commissions to the loan? What? Hold up. How are you handling agents who expect the lender to add in their commissions to the loans? I tell the realtor flat out, that is on you and the buyer to figure out. Don't get me involved. That ain't my business. Send over the agreements, send over the freaking the closing nets. Who gets what? Who's paid from what? Leave me out of this. That ain't got nothing to do with me. If I'm not sitting here pushing nothing on nobody. That's just me. That's y'all business. Figure it out. But if y'all agree to something, get it in writing. It ain't got nothing to do with me. All I know, when it's time to go to the closing, you get all the nets and everything where all the disbursements is going. Closing department handles that. Don't get me involved. We don't have nothing to do with none of that. You better get a buyer's agreement and make sure your people pay. Figure it out. Andrea Realtor said, I'm confused on the question. Are you asking should the buyer pay for the realtor? No. What this person on YouTube is saying is like, I guess they're loan officers. T-Bell, are you a loan officer? I'm assuming that, right? Said, how are you handling agents who expect the lender to add in their commissions to the loan? Basically saying that we're going to finance it into the loan in terms of a seller's concession. So basically, if we get a seller's concession, we're going to include their fee in the seller's concession versus using the seller's concession to pay down rate or do anything else. That makes sense? Andrea K. the Realtor. So that's what I gathered from the conversation, from the question, and that's why I said it ain't my business. So, brother, I watched that video with you and a brother from LA. Man, that was fire. Keep up the amazing content. I appreciate that. Yeah, shout out to my guy Nick, man. Make sure y'all go to my live tab. If you're on my YouTube, man, I mean my Instagram, or even on my YouTube, watch this live. Go to the live tab for all replays. I got some dope content, man. Download Rants and Gems too on all podcast audio outlets. All audio and everything is going up there too. All right, so we've been on this for 40 minutes. I'm out of here. Make sure everybody on YouTube go here and like it. If you just joined, watch the beginning of this. We were talking about the Fed's rate cuts, mortgage rates reactions, Redfin's heating up, housing markets that's heating up, and I gave a lot of information on why 2026. Listen to me very clearly. I feel like shaking y'all right now. Listen to me, y'all. This is going to be record-breaking year for all real estate professionals. This is going to be one of those years similar to like 2020, 2021. If you position right, if you're positioned properly. If you are a home buyer and you've been on the sidelines and you've been kind of lollygagging, this is your fucking alarm. This is your alarm. The alarm is sounding. Emergency. The feds are buying treasuries again. Rates are coming down. Unemployment. Oh my. Interest rates are going to start dropping. By this time next year, we should be in the low fives for a 30-year fix. Maybe high fours. If everything goes according to what I think is going to happen in the first half of 2026. And it's going to be phenomenal for people who can get in. But the competition, come springtime, this thing start moving in that direction, y'all. Competition is going to be there. So move accordingly. Get pre-approved. You want to work with me and my team again, you go to Garland Mortgage Group on Instagram. Link is in the bio. Go to the description of this video. Once we're done with this live, you'll have the information to apply with us. Let's work together. Let's grow together. I'm trying to help 300 of y'all in 2026 close on real estate transactions. Let's grow. But that's all I got for y'all, man. I appreciate y'all tapping in with me tonight. Any questions before I go? If you have any questions, put it in the chat. Put it in the chat if you have any questions about tonight's topic. If you are someone who's looking for a second opinion on a current deal you're working on, shoot me a DM or something like that. Let me know, second opinion, and you trying to get some answers. All right. All right. So that's all I got for y'all. Jamel said they're ready. I'm ready too. Shout out to everybody on everybody. Shout out to everybody on Instagram. Candy, you can go to my YouTube, MG the Mortgage Guy on YouTube, Candy, and you can watch the replay of it. All right. So everybody who want to watch the beginning of this, it was a lot of information, first 30 minutes. Go watch it on YouTube, MG the Mortgage Guy. Make sure you subscribe, hit the bell for notifications as well. All right. So if you're ready, shoot me a DM. Let's get to work, y'all. 2026 is here. I'm excited. I'm pumped. This was some good fucking news that came out today from the feds. I'm more excited about the quantitative easing light, $40 billion a month starting on Friday in treasuries. That's going to help mortgage rates a lot over the coming months. So stay tuned. Let's grow. Let's get to it. All right. Matt Garland, NMLS number 58700, better known as MG the Mortgage Guy. Peace.